Welcome back. This is Sam with privatefxclub.com. Welcome you back to this part 2 of my presentation entitled An Introduction to the Forex Market, a frank introduction to trading Forex. We got to the point where it's time to discuss the main currencies traded in this unregulated, exciting and stimulating market that we call Forex, foreign exchange, or spot FX. So we've got the dollar. The dollar, without a doubt, is the world's currency. And 90% of trades, 90% fully, contain the US dollar as part of the currency pair being traded. So I've put it at the top, US dollar. The euro, the European single currency, euro, WR. So compare the euro against the dollar USD. The euro against the Japanese yen, which is the next currency pair listed. Euro traded against Japanese yen. JPY, the yen, the Japanese currency, obviously. The next one I've got listed there is the GBP, the Great British Pound. The Great British Pound, when traded against the dollar, is also known as cable. The pair is known as cable. If a trader trades cable, it means they trade the pound against the dollar, because there used to be a cable that ran underground, under the sea, I believe, connecting Britain and America, the States, in the past. We then have the CHF, which is the Swiss franc, beg your pardon, also known as Swissy. Canadian dollar, or loonie. I've also listed there Australian dollar, or Aussie, and the New Zealand dollar is known as the Kiwi. Again, for obvious reasons. Now, what we just saw on that previous slide, these currencies are referred to as the majors. They are involved in the makeup of the US dollar index, if you've ever heard of that, the dollar index. The euro making up the bulk of that. Another currency that we haven't included there because it is considered a specialist is the Swedish krona. However, those major currencies are involved to a greater or lesser extent in making up the dollar index. They have a good daily volume and they're easy to buy and sell. Every country around the world has a currency that can be traded, but not all have decent daily volumes. Therefore, those major currencies are the most, in other words, they're the most commonly traded, they're the most liquid, and other currencies will be traded by specialists for specific reasons. Incidentally, if a currency pair has good volume but doesn't include the dollar, and I stated earlier that 90% of trades will contain the dollar, they're usually known as exotic pairs. And they are regularly traded, but they're not traded as much as the major pairs. When we have a currency pair, such as you can see on screen, the pound against the dollar, for example, or the dollar against the Swiss franc, we call the currency on the left hand side the base currency. So in these examples, the pound is the base currency in the first pair and the dollar is the base currency in the second pair. Notice that in GBP/USD the pound is the base currency, and in USD CHF Swissy the dollar is the base currency. So sometimes the dollar will appear as the base currency and sometimes it won't. So the pound is the base currency in pound US dollar in cable. If we have a price quote, for example, of 1.8024, that means that £1 is currently worth $1.8024. The market is saying that the pound is worth $1.8024 in this moment. Now, that price is going to fluctuate all day long. It's going to move. The market moves 24 hours a day. And it moves in increments or units that we can call pips, or price interest points. So a move from 1.8024 to 1.8094 is a move of 70 pips. And because it's gone up, we could say it's 70 pips north. We could say it's gone up 70 pips. You can say that the pound has gained in value against the US dollar by 70 pips, or you could say the US dollar has lost 70 pips to the pound. It's a move of approximately 0.7 cents. From 1.8024 to 1.8094 is 70 pips, or 0.7 cents. Let's move on and talk about bid and ask prices and spreads. The bid price is the amount that the market is prepared to offer you for the pair that you're holding. So a bid price is the trader's selling price. Or in fact, the bid price is what a trader will sell their holding at. As an example, going long on a pair. In other words, how much can you sell the base currency for? The bid price. I said going long on a pair, but I meant to say going short on a pair. Okay, so let's just go through that again. The bid price is how much the market is willing to offer you for the pair. So in other words, when you sell as a trader or short a currency, you short it at the bid price. The ask price is how much you'll need to pay to open a position. In other words, the buy price, going long, to go long in a currency. And in this example, which is a euro dollar at 145.40 bid, 145.43 ask, that means you can sell the euro against the dollar at 145.40, or you can buy the euro against the dollar at 145.43. And that difference of 3 pips is known as the spread. So for example, if your broker says, right in this moment, you can buy the euro at 145.43, you can also sell the euro at 145.40, that means you've got a spread there of 3 pips. And that spread, which is the difference between the bid and the ask price, will or should decrease when there's increased volume in a pair. We'll move on to this slide in the next video. I want to thank you for watching and see you again very soon. Thanks again.